So IRR, or an internal rate of return, I believe is an antiquated mode of actually looking at an investor's return. Because yes, it takes in time, which I like, and how much return you're making on a timely basis, which I think is important. But a lot of these deals, IRR can become skewed. And I can give you an example. If you buy a piece of land, you rezone it and you increase the value exponentially and you refinance and return that money to the investors, your IRR becomes infinite. So IRR on a multifamily investment is very important because how much cash flow are you getting? When are you selling? What are the multiple inequities? But when you have deals that are going through development cycles where you're selling off certain parcels, you're refinancing, you're returning some equity, or you're allowing some investors to come out sooner if they want to, the IRR ends up becoming a number that's difficult to gauge true performance. I believe looking at your multiple on equity and the conglomerate cash flows on an absolute basis really shows the returns that you're actually getting, and shows also from a risk-adjusted return standpoint, you can then gauge that absolute return against other benchmarks to see actually how you perform when you trade liquidity for returns. Because that's the other thing people don't talk about is, real estate in this manner isn't a liquid investment per se. So if someone's tying up your money and you don't have immediate liquidity, you better be outperforming the market, or they could be getting, a smaller return, but having a liquidity and having safety in an index fund. So when you take all of those things together, you begin to understand, where the return and where the expectations truly should be.